Siva, speaking about debt funds, one of the reforms was obviously demonetization, and a lot of money came into mutual funds because of financialization of savings. And we saw a lot of erstwhile fixed deposit investors also coming in. One is that they're graduating from fixed deposits to mutual funds, but on the other hand, in the past 3-4 years, we've seen a couple of accidents on the debt fund side also. And the credit ratings have also, in some cases, have deteriorated very sharply. And plus, on top of that, you're seeing yields also now rising. So, how do you summarize your past 3-4 years of experience in managing debt funds and managing investor expectations?
Actually, managing investor expectations more than anything else, isn't it? But yeah, I think we did get a lot of flows. But reality is, the Indian investor seems to have gone from FD to equity. I'm not sure too much of investors really moved from FDs to bond funds. It's still a very underpenetrated segment. Having said that, I mean, 1-year returns from short-term funds are still 5%, 6%. And if you had put a 1-year FD last year, you probably would have got some 6% after demonetization. So therefore, have you underperformed? No. The question is that today when you look, what you do is you're comparing the last 1-year return on a mutual fund versus what is available on an FD rate today. And that is quite patently unfair, but that's the way it is. Okay, fair enough. 2-year, 3-year returns are still looking all right. And as we know, because of taxation, most retail money stays for 3 years. So as long as you stay for a 3-year period, I don't think you're going to have disappointed investors in fixed income. But what I think has happened, which is a little bit of a disappointment for me over the last few years, is we've frittered away some of the best the world could have given us from a macro perspective. So let's say, for example, oil prices, which fell so sharply in 2014 onwards, and many other commodities which fell in 2014-15, which led to this big spate of disinflation, especially from the imported side. Food inflation has been under control for the last few years. Again, so we've had this nice sort of tailwinds for macro from a fixed income, from a debt investor perspective. And then suddenly over the last few months, it looks like all of this has come to a head. I mean, your oil prices have risen, your rupee has appreciated a bit, and now with this MSP increase, even the food inflation seems to be sort of rearing its head again. So I think there is some choppy times to come. But that's par for the course. I think the good news is it's all got priced in to a large extent. I don't think this is a surprise. I don't think oil is a surprise. I don't think MSP is a surprise anymore. Everybody has digested this. So yeah, I mean, I'm very optimistic about the outcome for bonds, especially short-term bonds. And on credit, you made a mention about some hiccups. That was probably 3-4 years ago. Time really flies. And if you look at the industry, mutual fund industry, we've been now in existence for 20-25 years running bond funds. And in a 25-year history across so many AMCs, if you can point to maybe 1 or 2 incidents and compare that with every other financial, like for example the banks, and look at the kind of financial accidents, as you said, which have occurred, I think we have done as an industry a phenomenal job of controlling that risk. And on the ground, we see a significant improvement in credit quality in terms of profit performance. And these guys have talked about it. And profit performance eventually leads to ratings. So I'm a lot more positive on the sort of cyclical recovery on credits over the last couple of years than I've been in the previous 5 years. Santosh is checking off that. You should ask him.
He said that he's a little disappointed that money has gone from fixed deposits to equities, but that's partly true. Money has gone also from fixed deposits to credit funds, accrual funds. You guys have also, funds that follow your strategy of credit funds, accrual funds, have also gotten a lot of attention in the past 3-4 years because of inflows and also because of a few accidents that have happened. How would you? Of course, now SEBI has obviously reclassified all the categories. So, there's a very clear demarcation of what a corporate fund can do and what a credit fund can do. But we didn't have so many experiences to begin with till about 4-5 years back about credit funds and what can go wrong. But we have seen what can go wrong now because of all the stress in the economy, etc., etc. So what is your big takeaway from the last 3-4 years? And how has that altered your strategy, or are you the same?
Frankly, I would disagree with many of the words you used. Sorry to say that, but you said credit funds had accidents, right? So if equity markets are volatile, That's the nature of equity markets. If GSEC market is volatile, it's the nature of GSEC market. If in credit funds you have defaults, why is it an accident? If you are willing to put money in credit funds because you believe that you can earn 200, 300 basis point higher returns, and if a credit downgrade happens or a credit default happens, why is it an accident? So if you don't want credit risk, you have AAA funds, you have FMPs, where you can invest in those funds. So if you're coming in credit funds with a expectation that you can earn higher, there's definitely a credit risk. And what do you mean by credit risk? Credit risk means downgrades, credit means default. But over a period of time, if those credit defaults and credit downgrades, despite that credit defaults and credit downgrades, if we can provide higher returns, then that asset category makes sense. If after a credit downgrade and credit default, you don't make as well as a AAA fund, then it doesn't make sense. So I will take strong objections to say that if there is a default in a credit fund or it's a downgrade in a credit fund, you should call it an accident. No, this is a part and parcel of the game. If you don't want to participate in that part of the game, you have AAA funds. So investors should, there was a time when a liquid fund giving negative returns, one of the foreign AMCs shut shop because liquid fund gave negative returns. So if overnight rates goes from 6% to 13%, what do you expect liquid funds to do? Right? You need to sell, and the returns will become negative, But does it make that a liquid fund is a bad investment option? No. Over a long period of time, liquid fund has delivered better return than a savings account and a current account. So one day negative return, big deal. So I think it's the immaturity of the distributors, of investors, of fund managers who believe that you should come in a credit fund, but no credit default should happen, no downgrade should happen. At all points of time, you should get 200 basis point higher return. I think the expectation is wrong. So therefore, we shouldn't call it an accident. We should say a credit fund, a credit default happened, a credit downgrade happened. It's a part and parcel of the game. So that's the first part. Second part, I think a bigger accident, quote unquote accident, is selling equity funds like debt funds. So I am finding it very difficult to sell our debt funds. When I go and sell my debt funds, the investor says equity funds are promising me 1% dividend every month. That is 12% tax-free. Now it's become taxable a bit after the last budget. So how do we expect to sell debt funds? But nobody uses the word accident for that. Right? I think that's the biggest accident bound to happen. I remember the US 64 schemes where the NAV was here and repurchase used to happen here. Today NAV is here and you're paying dividends consistently on 1%. So I think those are accidents which you are doing it of your own with a greed to get assets, with a greed to increase your AUM. Those are accidents. So I think, as Shiva mentioned, that most of the money went from FD to equity is precisely much of the reason is because of this mis-selling, which promises you 1% dividend every month. So over a period of time, the market will learn that it's not, obviously, it's not feasible for long term. You will lose money for a few years in equity. And therefore, then you'll realize if you need stable returns, you better come in a fixed income fund. In a fixed income fund, if you want a higher return, you take credit risk with knowingly that there could be some downgrades or some defaults. If you don't want to, you have a AAA fund or FMP where the chances of that quote unquote accident is low. Believe me, the AAA companies which can go default. So if you're not too convinced, wait for a few months or quarters. AAA companies can go default. So AAA is not sovereign risk. AAA is the risk of default or downgrade is low. Does that mean that you don't buy AAA? No, because the expectation is that because the chances of that quote unquote accident is low, therefore I will buy a AAA. If you don't want any of this, please go to a bank. But again, believe me, don't think that bank is sovereign, right? Bank FDs at some point of time, there's a chance that there were defaults there also. So I think we should have that entire perspective in mind when we are selling mutual funds. It should not be sold as it's a risk-free, credit fund will never see a default, equity funds will always give you 1% per month. I think those are, if you do that, mis-selling happens and then FD directly goes to the equity schemes.
So you're saying that a mutual fund is obviously not a completely risk-free product, but you have to understand what the risks are. And
absolutely,
there's a difference between accident and risks.
Accident is which you do of your own, which you're not supposed to do. Risk is a credit fund will have credit risk, interest rate fund. So many of the GSEC funds are given negative returns in the last 1 year. Right? Is that an accident? No, interest rate went up, macros went bad, and therefore gave negative returns. So I think everything has to be looked at that perspective. That's the nature of that fund. And the fund will...
Somewhat made in the last 3-4 years, a lot of attention has gone to credit funds because of events that have happened or because of risk factors that have played out. But the fact of the matter is that even duration funds also have come under a lot of stress. What's the future of a duration strategy? I mean, am I too dramatic when I say is duration dead and is accrual in, or?
For most investors, duration is dead because they just don't understand volatility. We have historically had what is called yield volatility close to 100 basis points in India. So if you multiply that with duration, and in income funds the duration is 7 years and more, which means your price volatility is 7% or more. Right? If your YTM is 7% and your volatility is 7%, then you have a very reasonable chance of making nothing in several years. So I think it's a very volatile asset class and it's simply not understood. For most investors, direct duration exposure, don't do it. If you really want to play duration, play it in a dynamic bond fund or something where someone is taking a call on duration. For most investors, it makes sense to stay in shorter products where that risk is much lower. A fund with, let's say, a 1-year duration, 2-year duration, and now everything is bucketed so nicely. You get 1 to 3, 3 to 4, 4 to 7. I mean, you get all these slices and dices. I heard the previous panel and completely on board. There is just too many categories. It's a complete mess. But having said that, you do get your choice. You can buy much shorter term products, which I think are fantastic from a risk reward perspective. So I think investors should stay short. It's a risk that we can explain and can be understood. Within short, of course, you have the choice, as Santosh just said, about do you want to be in a credit product or do you want to be in a AAA product that's available to you. So I think the choice is available. And yeah, I don't want to say duration is dead, but play a duration in a very different way. Is what I would say. Don't play it just long.
But even Haldia from Prime Database. My question is to the panel as a whole. Perhaps Navneet, you can answer it as well. Hearing today and also in all my interactions with various people from the buy side and sell side, there is a lot of optimism about the reforms undertaken by the government, various structural changes which are taking place. Everyone in the financial market, I keep on joking, at least seems to be a huge fan of the current government. However, this optimism is not found in the larger discourse outside the financial industry. So what do you ascribe it to? And also, I would like to understand, how do you see things changing in case of a change in the current government next year? Navneet?
So I think it's a mixed. Everybody knows that the recovery is not very broad-based. I mean, there are parts of the economy, so there are like 4 cylinders on which economy runs. So you have the private consumption, which has been doing well. You have exports, which are chugging along not too well. Services exports are picking up, not so much in goods export. Government expenditure, which has been doing well, trying to do the heavy lifting on the infrastructure side, and the private consumption, government expenditure, the private capex is something that will take time. You still are dealing with the challenges on the excessive leverage, both on the corporate sector balance sheet and the banking sector balance sheet. They need to get addressed. Capacity utilization need to go up, and then you'll see a far more broad-based recovery. Now, again, a lot of these anecdotal evidence in terms of you meet somebody during the day and you feel very excited, and you meet somebody else and you feel that no, nothing is happening. I think we track 40, 50 high-frequency indicators. There are so many of them. We look at CV sales, you look at cement production, you look at like air traffic, foreign tourist inflow, variety of them, retail lending. They have been continuously been surprising. I mean, tractor sales, most of the fast-moving consumer goods, particularly on the rural side, they have been doing well. But at the same time, there are challenges. The bank credit, particularly to the industrial sector, is like close to zero or negative. It's not growing. And there are maybe part of some of the core industries which have not been growing. That will take time. But initially, I discussed that all of these reforms that have happened, what are those 5 transformational impacts that we'll have over a longer period. And if I can talk about the agenda for the next government. So my view that I think a large part of the legislative agenda has been, I won't use the word finished, but I think we are more or less there. What we really need to do, and they never grab the headlines, is actually the administrative reforms and the judicial reforms. If you really want to achieve the ease of doing business, if you really want entrepreneurship to flourish, if you really want innovation in the economy, then what the next government needs to focus is not how many more bills get passed. My view that I think even if Parliament doesn't run for a couple of quarters or years, we'll be okay. We need to focus more on administrative reforms and the judicial reforms to ensure that everything that has been done over the years in terms of overall reforms, I think we reap the full benefit of that.
And his second question